Gloria, unmute your microphone.
Oh, sorry. I'm sure I'm now fine. Yeah, good afternoon, dear CPA members, friends, and affiliates, and everybody. You are welcome to this webinar. It's on IFRS 16, leases. And we thank ICPAU for ensuring they deliver CPD hours free of charge to our convenience without having to pay for fuel. That one is a very good applause for you, ICPAU. My name is Gloria, and I will be your chair for this session. I'm going to introduce our presenter for the day, that is CPA Kenneth Makanga. CPA Kenneth Makanga is a partner at BDO East Africa with extensive experience spanning over 10 years in accounting, audit, taxation, and business advisory in various and diverse industries. At BDO, he's responsible for the delivery of the services in Uganda, and he's the tax engagement partner for all clients. Yeah, he's the tax engagement client for all the clients. I mean, engagement partner for all the clients served in East Africa. Before that, he was responsible for setting up the internal audit function in Southern Sudan, MTN. And before that, he also worked at KPMG Uganda, where he was responsible for several value-adding audits. He has quite extensive experience, which I cannot complete. And in the interest of time, I will invite CPA Kenneth Makanga to take us through this presentation. If you are new to Zoom, you can click somewhere there is a chat, and in those chats, you can send whatever you have, and then you can also click on Q&A, and as he presents, you can post your questions and answers there. We shall give him time to first present, and when he's done, then our questions will be attended to. You can raise your hand. That will be after we have answered the questions that would have been posted under Q&A. We shall give time for people to raise their hand and ask whatever question they have. So CPA Kenneth, you are welcome this afternoon. Feel free to take us through, and you can begin.
Thank you, CPA Gloria, and thanks for that wonderful introduction. I'm afraid because of COVID-19, I don't want to share a camera clip of myself because the salons have not been working for the last 6 weeks. And clearly my facial might not look like the picture that has been saturated by ISPAO. But for the benefit of other members, I'm going to share with you the presentation that I'm going to take you through, that I hopefully will be able to run through in the first 1 hour and dedicate the probably rest of the hours interacting and responding to your questions or queries that you might arise as a result of my presentation, or some of the queries that you might be familiar with when it comes to this subject matter. Now, I will ask, I think, to make it very easier for all the participants to have the presentation that I prepared be projected on this screen, and so that we can begin. And I will ask the Institute to do that. I will be able to navigate as we proceed. So.
Thank you. As Peter does that, members are already demanding to see your face. So maybe you could just greet them and you mute your video thereafter. Yeah, I think members can now see the screen.
Want to have this projected very well.
Yeah, Peter is at it.
Presentation is
I think we are now good to go. Kenneth, we are now good to go.
Good afternoon, members, once again. I hope you're able to. Yes, CPA Gloria?
Yes, you are on, Kenneth. You can start.
All right. Good afternoon, members. Once again, apologies for that slight glitch. It must be the internet. I welcome all the colleagues, CPA members. I welcome all the aspiring CPAs. And for those who are already on the journey for becoming CPAs, I really want to make sure that I don't leave you behind. So as the webinar stated, we are just gonna go through leases, and ultimately, it is important to also deliberate on the impact of COVID on this subject matter. But to make sure that everybody follows, we are going to deliberate a little bit in detail what IFRS 16 is all about. Then I will also mention a little bit on the impact of COVID. So as you move on the next slide, which shows the agenda for the presentation, I'm gonna share the overview. I'll identify a lease contract. At the end of this presentation, I'm sure all members should be able to identify a lease contract. We should be able to define a lease term. We'll talk about how to measure leases. And the most, I think, important aspect for many accountants, how do you present leases in the financial statements? Then IFRS also recognizes that leases can be modified. So we'll talk a little bit there. And as you know, in the lease transaction, there are always two parties, the lessee and the lessor. So there is a slide or slides talking about that. And then some unique lease arrangements that might result in sales and leaseback. Our crowd.
Hello, Kenneth, are you there? We seem to have lost Kenneth.
I'll ask the moderator to move us to the next slide, which is to identify a lease contract. Okay, in terms of overview, you can, and this is an aspect that I've mentioned to many CPAs. If you have read a standard, it is always important to start with appreciating the scope of a standard, because the chances are, if you don't that you might defile the standard. You might misapply it. So the scope for this standard really requires all lease of certain assets, but definitely some assets are out of scope. Assets that result from concession arrangements are covered by IFRS 12. Some lease arrangements that relate to minerals are not part of this standard. And definitely, there are some lease arrangements that affect biological assets. this standard doesn't cover them. As you will see as well, we'll talk about the recognition of the standard, which definitely brought many of the leases onto the balance sheet. We'll also mention the unique aspects that is different from the lessors and the lessee point of view. One aspect that is also very good to know, that there was a project to merge the IFRS with the US GAAP. And this is one of the standards that was anticipated to be in that project. But unfortunately, as you will see, there's a divergence between what the Financial Accounting Standards Board, that's the board that sets accounting standards for the Americans, and what IFRS concluded. And then we'll talk a little bit in terms of transition. This standard is and was effective as of 1st January 2019. So if you're an accountant and you prepared your financials for the year ended 31st December 2019, my expectation is that this standard affected you. And if you didn't, higher chances are your financial statements are not compliant with this standard. So that's just an overview, which at the end of this presentation, I'm sure all these aspects I've mentioned, we should be able to be familiar with. If we move on to the next slide, basically we show that for you to be able to apply this standard, there's some exemptions. Some leases are left out of application of this standard. And there are two exemptions. We'll talk a little bit in detail, but the two exemptions are available if the lease arrangement is short term, if you have a lease arrangement that's less than 12 months, and you are sure that the lease will not extend beyond 12 months, this standard allows for an option. It is optional for you not to account for that lease arrangement using that standard. And if also the lease arrangement is about assets that are low in value, then you are also allowed not to elect not to use this standard when you're accounting for that. As you will see at the subsequently, this exemption is a shortcut for you to simplify things. What I've seen in practice, many accountants really want simple things. They don't want complexity. And I've seen many try to actually fit into this window, which is a narrow window, and we shall try to see in detail who can use these exemptions that are available in this standard. There are only two, and they are clear. We'll talk a little bit on that when it comes to defining the lease. Now, if you also move a little bit on the next slide, it shows you that this standard affects all the elements of the financial statements. It affects the statement of financial position, and it also affects the statement of comprehensive income, as you can see. And I will take you through on how the presentation of these elements are affected, and I will illustrate that through the presentation. Then on the next slide, you will show that this standard is definitely applicable, as I mentioned, on 1st January 2019. And there are two methods that are acceptable for you to apply the standard. Those methods, either you do a retrospective application, which means that you are allowed to be able to restate the numbers, or the modified retrospective application. Now, members, you allow me to go and really dig into the standard by moving into the next part of the presentation, where basically I'll take you through on how to identify assets that are or contain a lease. Now, I will encourage you that if there is any area that you fail to understand, let it not be the next 5 slides. Because if I lose you on this slide, higher chances I will struggle to be able to really understand how this standard impacts you. So in the next slide, we are going to define what a lease is, and this definition is contained in the standard itself. It says that a contract or part of a contract that conveys a right to use an asset. And that means, in bracket, there must be an underlying asset in a contract for a period of time in exchange for consideration. Just to examine a few elements within this definition, we know very well that from other from even a legal perspective, that a contract can be both written or oral. So absence of a formal document should not excuse you from saying you don't have a lease arrangement. A contract can either be written or oral. However, that contract, whether written or oral, gives a right to use. You, the recipient, in this case will be called the lessee, you get access to an asset which is underlying, in most cases can be physical, for a period of time. Meaning the contract should be clear that you're going to use this asset for this number of days. And actually, from here, you also notice that the period of time might not necessarily be years or weeks. It can be actually quantified in terms of production units. I can lease you a machine, and I say the machine is going to produce this unit of products. For example, if I'm 90 and I say I'm giving you a machine and it's going to produce 40 million masks for the Ugandans, and we'll quantify how long that takes for that. That can be a period of time. So it is important that you appreciate this definition, because if you don't, you're going to struggle to identify what is a lease and what is not a lease. On the next slide, there are just a little bit of some steps that I want to share with you that can guide on how to identify a lease. So I'll ask the moderator to move on the next slide, which definitely shows that the first step when you're trying to identify when a contract has a lease arrangement or not is to identify if there is an identified asset in the arrangement. So I will ask the moderator to move on the next slide, which I think slide number 9. In that slide, you will see on that slide, you will see that you're able Madam Moderator, can we have the screen back? Yes, that is the screen I'm talking about. You will be able to see that the first step is you identify whether an asset is in the contract. If you read a contract and you're struggling to identify a specific asset, the answer is that is not an lease arrangement. You should not apply this standard. And you can see the path. If there is no identified asset, please do not bother applying this standard. If you read a contract, for example, if you read a rental agreement, if you will say, I'm leasing this house, I'm leasing this floor, I'm leasing 300 square meters on the 4th floor of a building located here and there, you can identify the asset. It is very specific. You're identifying a vehicle, engine number, VIN number, registration number. It is very identifiable. If you cannot identify, do not even bother looking in this standard further. However, if you can, you go to the next step, which says, does the lessee obtain substantially all the economic benefits? In this case, this is not any different from what IS 17, which was replaced, probably also used to impart to, that you who's going to use this asset now, who has the right to use the asset, are you going to be using the substantial economic benefits? Meaning, if the vehicle is probably going to, its useful life is 8 years, and you're going to use the vehicle for 8 years, it is fair to say that you're going to be substantially using the economic benefits, because 7 out of 8, you've almost taken the life out of the asset. And in that case, if it is a yes, we are sure that this IFRS is for you. If it is not, then if you're just getting a small component of the economic benefit, substantial, this standard might not be applicable on that arrangement. However, if it is, the next question, which is the third question for you to conclude whether a lease arrangement exists in a contract, is to ask yourself, does the lessee have the right to direct the use of the asset? This is very important. And this is where sometimes we shouldn't, sometimes these arrangements actually get confused from. I want to give a classic example. You might have an arrangement with a transport company. For example, we know these yellow cards, so that if we have any of our employee needs to go to the airport or to go to outside office, we call you, and then you drive them and drop them. This contract doesn't give you the right to control the cabs of the service provider. They can bring a pink one, a yellow one, or another national number plate. All you need is just a cab. So you don't have the right to direct the use of the asset. You cannot say, I wanted the other premium that was brilliant last time. It's not specific in the contract. So if the contract doesn't give the right to direct use of the asset, it is not, this standard does not apply to that arrangement. But if it does, then the right conclusion is that that contract contains a lease arrangement. These three elements are very critical. And I'm going to give you an example shortly so that I think it can be polled and you confirm to me whether you really get the message that I'm trying to share with you. On the next slide, which is basically where the next example should come from. But before we see the example, I want to share with you that in terms of the control of the asset, there is an element which we call substitution rights. If the supplier of the asset has the right to substitute it for another asset, higher chances are that that arrangement doesn't qualify to be a lease arrangement. And that I've given a good example that if you really have an arrangement with the cabs company to give you taxis, they can bring any car, whatever they want. So if they can substitute the assets that you're using, and the supplier has the practicability, and usually it confers benefit to them, meaning they can use that same asset that they give you to service another customer, then higher chances are that that arrangement is not a lease arrangement because the supplier, you don't direct the use of the asset. The supplier in this case calls the shots. So on the next slide, there is a question that I want to share with you, and I would want you to read it, but I'll read it still aloud. So I will ask the moderator to move us to slide number 11, which basically already checks on whether I've been able to communicate to you. So I will ask that we go to slide number 11. And here is the scenario, okay? Customer enters, scenario one, there are going to be a number of scenarios in this presentation. A customer enters into a 10-year contract with a freight carrier. And this case is the supplier to transport customer goods. The contract requires the supplier to use rail cars of a particular specification, and it will require 20 rail cars to transport the required quantity of goods over the 10-year term of the contract. Supplier has a large pool of rail cars that can be used to fulfill the contract. All the rail cars are stored at the supplier's premises when they are not being used to transport the goods. Costs associated with substituting the rail cars are minimal to the supplier. So the question, which I will ask also the moderator to pose by clicking next, is, are the supplier's substitution rights substantive in this example? And I would want you to really take a step. I'm informed that you can be able to maybe take a poll and answer this question. If not, I want you to be able to answer this with integrity, and you will mark yourself on the next slide. If you have failed, please don't be embarrassed. So this is the answer, as you can see. I told you that the first step when you have an arrangement is to ask yourself, is there an identifiable asset? So in this question, in this scenario I've shared with you, the contract does not contain identified assets. They just say railroads. I mean, they are 20. They are not specific. If you have ever seen a train, the wagons can be as many as 20, but you cannot identify that they brought wagon A, even if they are special in nature. So it will be you will be defining this standard if you use that scenario to conclude that there is a rail lease arrangement, because it is very clear in that scenario that there was no identifiable asset, okay? And even if there was, even if we are rhetorically to answer that yes, you can see that the supplier could be able to substitute the rail cars that he was giving the customer. So meaning the supplier was calling the shots. The customer is not calling the shots. So there is no way you would conclude that that scenario contains a lease arrangement. So it is very important. This is the part where if you're an accountant, it is important for you to be sober before you really define the standard. You need to be able to identify whether the contract defines, gives rise to a lease arrangement or not. First, you need to identify the asset. If you can't, please look for another IFRS. This IFRS might not be applicable to that. Then last, just to emphasize on that point, I would just want to remind you on the 3 steps. And on the next slide, basically, I'll talk you through on the rights to direct use. As you can see, that the 3-step model is very important to identify the asset. But there are some assets that you might not be able to conclude on who has the right to direct of use. And there are some 3 elements. On the next slide, Mr. Moderator, there are 3 cases that might arise from that. You might find that in a contract, the supplier is the one that directs the use. This one is if the supplier is the one that directs the use of the asset, it does not contain a lease arrangement. If it is the customer, it usually contains the lease arrangement. And this is where it becomes very difficult for you if you have a rental agreement, even if you're renting parts of a property, to say it doesn't contain a lease arrangement. Because for many of the tenants, no landlord will tell you, put your chair in the sitting room like this or like this. You decide. You can actually decide to convert a sitting room into a bedroom. So you direct the use as the customer. So those contracts, usually rental agreements, you see, they usually automatically fit into this standard because you, the customer, are able to direct the use. The other aspect is in terms of the predetermined nature of the asset. The contract might be silent on who directs the use, but the asset itself might be very predetermined and designed for you. In that case, you need further analysis. There are some contracts where the asset they're leasing to you, you are the only one who can use it. For example, if you are in the business of probably oil drilling, and they have to make a drilling equipment that is unique to the Albertine region, even if the supplier is just leasing it to you, you're the only one who can use it because you're a monopoly. So in most cases, you as the customer, even if it's not clear, it might be predetermined that you're going to be the only one using that asset, so it might be a lease arrangement. So that's why if the asset is predetermined in terms of use, further analysis is required. So I want to cap it up by saying this step is very important for you to appreciate on the next steps that I'm going to walk you through. And the next step, I want us to talk up a little bit of lease arrangements that contain 2 elements. You have seen arrangements, and I have seen a classic one. You might lease a photocopier or a printer. I know companies that do that, but the same company that leases the photocopier is the one that maintains the photocopier. So that is also something that this standard has taken into consideration. There are 2 choices for you in that arrangement. You can stipulate the element. In this case, that's what we call a bundled lease arrangement. You have a maintenance and a lease arrangement. The option you have is to allocate, because we expect that in that contract, the leasing arrangement will have a different price and the maintenance arrangement will have a different price. So you can allocate the consideration and account for the lease arrangement in this standard and the maintenance in a totally different standard, which might be IFRS 15. But it is also acceptable if you bundle them together and account for them as one lease arrangement. You will see in the subsequent slides that when you choose either of the 2, you might have different financial impact in terms of the value of the lease. So, but it is totally acceptable to either bundle or not to bundle. I'll ask that we move to the next section of the presentation. And in this section, I want to talk about the lease term. The other important aspect in once you identify the lease and you have identified that it has a lease arrangement, you're sure that there's an underlying asset within the lease arrangement. The other aspect is to identify the lease term. Now, the lease term has 4 or 5 components. One, there might be a non-cancelable period of the lease. This includes usually it's very clear in the contract that you have this asset for this long, and then that is non-cancelable. Like, it is very clear that you have the house for 5 years, but it can be renewed in 5 years. And that second option is the extension, which can be available to you as the lessee. The third is you can also, usually all contracts have options for you to terminate, okay? Either, and then you, the lessee, or the lessor can decide on to exercise that option. So the lease term can be an addition of those 3, depending on the circumstances. And I want to walk you through on those circumstances. When do you add the 3? So on the next slide, I want to share with you what it takes for the extension to be considered as part of the lease, okay? If the lease has an extension or termination option, it should be included in the lease term if the lessee is likely to exercise that option. And we concluded that the lessee is likely to exercise that option if the market rates for which the lease arrangement relates to is probably favorable to the lessee. For example, you lease a building in Chireka and your landlord has bound himself that you can really extend the lease after 2 years for a fixed fee of 400,000. But you know your neighbor in the same house, which is probably poor quality, is charging 600,000. It is fair to say that once that lease, the non-cancelable position period ends, you will exercise the option to extend because the market favors you. If also the improvements in the lease, for example, we know many entities, when they really move into the office, they do residual improvements. And usually if you want to leave, then you will have to really dismantle those lease improvements. So if you exercise the option because you really want to stay in that office, higher chances are that you will exercise that option in your favor as the lessee. If also the cost of terminating the contract are high, higher chances are that you will stay instead of moving when the option comes to you. So these are some of the factors that we consider, and these factors are important because, as you will see in the next slide, is that the lease term has a bearing on how you measure the standard. I have another scenario here that I just wanted us to go through, and I'll go through quickly. Still the same approach. I want you to answer at your own desks, wherever you are, and say company X enters into a contract, a lease a property for 4 years, with an option to extend for 4 years. The lease payments are 100 million per annum over an uncancelable period of the lease, and 4 years period covered by the extension. Meaning, after 4 years, you have the option to extend for 4 years, paying the same amount. So the following factors are relevant. Market rentals for comparable property in the same area are expected to increase 10 per annum. So meaning, after 4 years, that 100 million you're paying, your peers will be paying 40% above the 100, probably 140 million. And you, as the lessee, you intend to stay in the business same area for 10 years. Then we also know that the location of the building is ideal for the relationship of the suppliers and customers. So the question I'm asking, how many years is the lease period in this case? If you were to look at this scenario, if you were to ask yourself, how many years will this be? And I think for me, the answer I know is on the next slide, which I'll ask the moderator to move into. But it is very clear from what we have explained that this lease period is actually 8 years, because you can conclude without doubt that the lessee will exercise the option of extending for the further 4 years. So the lease term, even before the option, before the cancellation period ends of 4 years, is 4 + 4, which is 8 years. So I want to take you through and show you the impact of the lease term in terms of accounting for leases. So for that matter, I will ask the moderator to move us to the next slide, which basically shows how the impact is. But before we go to the next slide, there's this slide in terms of which I probably promised that I'll talk a little bit more. I have, and from the few accounts that I've been able to see through my practice, I have seen clients who have tried to come up with all creative ways to run away from this standard. They explain these leases are short-term. Please, it is very clear in the standard that short-term leases are less than 12 months. If the lease arrangement has an option to extend beyond 12 months, it is not, the standard actually makes it very clear that automatically it ceases to be a short term. It is assumed that the lessee will exercise that option because nobody really rents an asset or a property purely for 12 months. If the contract contains a purchase option, after 12 months or 6 months, you can buy that asset. You cannot enjoy this exemption of short-term exemption. If also the lease says that you can cancel on your own timing, that is not ground enough for you to say my lease is short-term just because it allows you to cancel anytime. The standard is very clear that that is not a reason for you to conclude that if it is says 4 years, but you can cancel anytime without even penalties, that is not recognized as a short-term lease. And indeed, this arrangement of whether the lease arrangement is short-term or not is applied lease per lease. So if you are a company that has branches and have offices in different districts, each tenancy agreement that you have is a separate lease arrangement. Just because you have one in Chireka that is 12 months does not in any way you really force the rest of the leases for you to be conclude them that they are 12 months. So it is possible you might have the same assets. Some might really benefit from this exemption, others might not. So each contract, each lease arrangement is actually accounted for on a case by case separately. So I just wanted to make this very clear because many accountants I know are experts in looking for shortcuts and trying and run away from just the requirements of the standard. So this exemption is very specific. If we go to the next slide, I will show you the motivation why many accountants want to run away from this requirement. And before we do that, it is also very clear in the standard that the revisions of the lease term, even if it is provided for in the contract, it is not expected that the lessee has to think for the landlord or the lessor. In most cases, you will find accountants arguing our landlord is unreasonable, he can cancel anytime. It is not your job as a lessee to think what the lessor will do. So if you are to revise the lease term, these are the two conditions. On the next slide, I want us to go through quickly on what it takes to measure the leases. This is the financial impact. And it is very clear that once the standard meets, once the contract meets the requirements of being called a lease, it gives rise to two elements, which all of us should be very familiar with. If not, it is important that whatever it takes, even if you need to cram them at the end of this presentation, you do so. It gives an element what we call the right of use. Basically, that is the right you get for using the asset that's in the contract, and it also gives rise to a lease liability. So we are going to look at how do you measure these two elements that are a result or a product of you applying IFRS 16 to a lease arrangement. We'll start with the lease liability. And in all cases, this is actually something that is very key. When you're measuring the impact of an IFRS 16 arrangement, you start with the lease liability. So on the next slide, I'll give you the formula on how to measure the lease liability. This is the formula. The lease liability is payments less lease incentive receivable plus variable payments plus residual value guarantee plus exercise price of purchase option. And definitely, it also allows for you to be able to, in terms of exercise price of termination option, to include that. So you get your lease liability. On the next slide, I explained a little bit more on what those elements mean. The fixed payments, basically, these are payments set in the contract. These are very clear. If you have a rent of a property of a fourth floor and the rent is 400 per month, those are the fixed payments. So you just have to multiply them and discount them with a variable that we are going to see for you to arrive at the first element of the formula, which is the fixed payments. Then variable payments are those that depend on the rate. We know contracts that say you're paying 400 in the first year, but in the third year, we'll increase it by 5%, by 2%. If that variable is dependent on the rate, then you also include that, you discount those variables, include that in the computation. Then there are also incentives. Basically, if the lessee is required to maintain the asset in good condition, you need to include the amounts that the lessee expects to make the asset return. For example, we give you a car and we say it needs to be functioning after 5 years, the engine should be in a good state, and we know what it takes for you to maintain the engine in good state. Those residual value guarantee, basically the guarantee, I would say it is the equivalent of what you would call the fair value at the end of the contract, how the fair value of that asset that you're leasing. And then lastly, the purchase termination options. In case you need to be able to make good, to restore the asset in its good use at the end of the contract, those amounts that you expect to spend are also included in here. We know contracts that say, for example, if you're renting an office and say all your leasehold improvements, all your essays, and all the server things that you put in, you need to make sure that you remove them and give us the space. If you had painted it blue, put it back to white how you got it. Those are purchase termination options. They also come into factor when you're trying to determine the value of the liability. So I want to give you another example and just hammer home the point I'm trying to make. On the next slide, there is an example which basically is going to really confirm how to apply this standard. But before we do that, there's an element that I've been mentioning, that for you to get the value of the lease liability, you need to discount the cash flows that I've mentioned in the last slide. So what discount rate do you use? The standard says that it's the interest rate implicit in the lease should be used unless it's not readily determinable. The truth is, in practice, this is very hard to get. A lease implicit in the interest rate implicit in the lease, as the lessee, you can never get it. It is actually fair to say it's only the lessor who knows, because one way of arriving at that is to determine the direct costs that the lessor incurred to be able to arrive at that amount that is charging you. And I don't think any lessor will tell you that information. In some instances, the other option of identifying that is to determine the fair value of the asset at the end of the lease. For example, we know if you're renting a house and you're renting it for 10 years, after 10 years, it's not going to say that the asset is actually going to be zero. The house will still be there. But we know that at what fair value will it be in 10 years? So we need to be able to determine that and get the rate, which becomes very complex. So what the standard has allowed, that if the implicit rate is difficult to determine, which I would say in most cases is, therefore, incremental rate of borrowing may be used. And how do we arrive at the incremental rate of borrowing? You look at similar security for the assets that you're using. If you use the car, you need to get, if you're to go to the bank and buy that asset, what would the bank charge you? Borrowing similar to the term of the lease. And it has to be the same currency. So if you don't have a loan on your books, you probably struggling to identify the incremental rate of borrowing. You just go to the market and ask, if I was to lease this asset and Stanbic was to really sponsor it, or any of the banks that do lease arrangements, what interest will it charge me? And that would definitely be a rate that is acceptable to use. What is also true, that the weighted average cost of capital is not accepted to be used to discount the cash flows that I've mentioned. So in practice, what I've seen, most of the clients and most of the people that apply this standard, they use the incremental rate of borrowing. And what I've seen, many Ugandans actually, many entities actually dealing with the debt. So whatever debt that they are having, if it is for a tenure that is similar to the asset they are leasing, it is acceptable to use that rate. So I want us to really dive into an example, but before so, on the next slide, I also show you how to measure the right of use asset, because there are two elements. So we have looked at the lease liability. What about the right of use? That's where it becomes very interesting. As you can see, the right of use asset is measured by starting with the lease liability. So the formula I showed you on how to measure lease liability, the answer you get is the starting point. You add payments made at or prior to the commencement of the lease. So for example, if you have discounted the future cash flows in the contract, but you also made some money, you paid some money to a broker to really get that asset, it is acceptable for you to put that as a cost, payments made prior or at the start of commencement of the lease. It is acceptable for you to include that in the value of the right of use. Initial direct costs, those are costs that you incur probably to also make the asset come to use. It's also acceptable. Costs to remove or restore is also acceptable. And this is where we're talking about, you need to project what it will take you to make sure that the asset is back to its whatever obligation that you have in the lease arrangement. And then you also reduce that with the lease incentives. In this case, the lessor might probably say, I've given you a discount, or I have forgiven you lease of 4 months, fit out period. You didn't need to take those incentives out, and then you get the right of use. So now we know the formula of lease liability. We know the formula of right of use. I think let's put the knowledge to the test by going through the next example. I will ask the moderator to move us to the next slide, which has the example. And the next slide, it reads that entity Z, which is the lessee, enters into a 5-year lease of a floor of a building with a 5-year extension option. Lease payments are $50,000 per annum, including the extension period. All payable at the beginning of each year to obtain a lease. Leasing incurs initial direct cost of $20,000, $15,000 paid to the former tenant. I think this is true in Uganda. I have heard of goodwill. Before you enter a mall, you have to pay the former tenant goodwill. So this example is showing exactly that: $15,000 to a former tenant occupying the floor, and $5,000 to the state cash commissioner. Really typical of what Ugandans do actually. The terms of the lease also require entity Z annually to pay the lessor 2% of gross sales, which is pegged on the revenue from the space being rented. And entity Z concludes is certain it will exercise the extension. So there's no need to debate on the lease period. It is very clear they will exercise. So 5 + 5 is 10. The rate implicit in the lease, like I said, very hard to determine, but they have given you that the borrowing rate is 5%. So what I want us from is to, how do you calculate the lease liability? I want us to move on the next slide because it's an example which has the answer to walk you through. The formula for the lease liability is here. Lease payment, less lease incentive, variable, residual, exercise price. In that example, I showed you that you're supposed to pay $50,000 for the next 10 years, but the payment is made at the start of the lease arrangement. So meaning the future payments are 9 for the 9 years. If you discount them at 5%, please, if you really do not discount, I cannot help you on this webinar. But I'm sure if you've gone through CPA classes, you know what discounting means. If you really use the discounting factor of 5%, you will see that you will arrive at that figure of 3559391. In that example, we show there were variable payments, but the unique element is that they were not pegged on the rate. They were pegged on profits. Those are not acceptable in this standard. That's why we put a nil. There's no residual value guarantee. There was no exercise price option. And in terms of the exercise price, there is also nil. So you can say from that example, the lease liability is simple as discounting the 50,000 for the next 9 years, and that's the figure you get. So what is the right of use asset? What is the value? On the next slide, we have an answer for that. And it, like I said, the formula is you start with the lease liability, payments made up front, prior or commencement, plus direct costs. So we saw the lease liability is 359, 355, 391. The payment that was made up front, because you have to pay 50,000 at the start of the lease, that is the 50,000. The direct cost is the 20, which was the 15 to the former tenant and the 5 to the brokers. And that is acceptable. So you get the 425,391. This is the value of the right of use of asset. Now, I think to the accountants, they're scratching their head and say, how do you really post this into the general ledger? The next slide answers that question for you. So I'll ask the moderator to show you that the entry that you would make at the start of this example of lease arrangement, you will debit the right of use asset. And we know that when you're debiting, that is purely an asset. You credit the lease liability, and definitely we said you had to pay the 50,000, so that involved the cash, and the 20,000, which is the 70. So this is how your entry balances, okay? So the credits in dollars match to the debit, that is the asset. And that is how you make the entry into the books of any finance, of any entity for that lease arrangement. So with that, clearly, I think we have articulated how to measure that. I want us to move on to the next topic, which is of importance. And this is the presentation. So we have seen the elements, right of use of asset. On the next slide, you will see that the right of use of asset can be presented either as on the face of the statement of financial position or in the notes. So I ask the moderator to move to the next slide, which shows that just an illustration of how to present this. So you can see in this illustration of a statement of financial position, after the current assets, then you have the non-current assets, PPE comes, and then you have right of use of assets. On the face, if you have seen some of the published accounts for the banks, you will see this element has come in. In this example, it assumes that there is a comparative, but in most, actually, some of the financials, the comparative would have been nil because 2019 is the first year that they applied this. On the next slide, I'll show you if you're to put, if you're to put it on the note, you can include the right of use as part of PPE because that is your asset for you to use, and you can just amalgamate it. I will also show on the next slide, it shows you how to present that note. So if you put it as part of PPE, it will not be on the face, but it will be in the note. And in the note, you can be able to distinguish between right of use of the different classes. You might be leasing assets, vehicles, so right of use of vehicles, right of use of equipment, right of use of property. So this is all within the note for PPE, which adds up to the face of the financials. Both options are acceptable. In practice, I've seen the option number 1 is actually something that many companies have adopted because usually the number is significant and you want to show it separately. Then what about the lease liability? So if we go to the next slide, you will show that the lease liabilities can be also in the statement of financial position as liabilities. And on the next slide, it shows you can either group them or show them separately. In this illustration, it is shown as separately, but as you know, the statement of financial position, especially if you need to classify it between current and non-current, you need to classify those elements. So the current option in the current liabilities and the non-current option in the non-current liabilities. So that is also acceptable. On the next slide, it is also acceptable if you combine this with other liabilities. And in this case, you can see here, the illustration combines both the debt and lease liabilities, but the note will split that further. So I want us to also talk about the statement of comprehensive income. How does that come up? On the next slide, you will definitely see that the statement of comprehensive income, the amortization of the right of use or asset can be really either you show your expenses by function or by nature, and you know that is a requirement from IS1. I know some of the accountants usually mix the two, but it is totally not acceptable within IFRS. So if you choose by function, you can amortize that either you show in the expenses as distribution, administrative, or selling and marketing, depending on what the asset is being used to. You show that expense in those elements on different categories. Then the interest should be part of finance costs. And if you're showing the expenses by nature, then you can aggregate them and show them as depreciation and amortization, because you'll have that category on the face of the statement of comprehensive income. The one rule here, which is true, that if you're choosing either function by nature, the interest on lease liability should be under finance costs. It doesn't matter whether you're using nature or function, the interest arising from lease liabilities should be under finance costs. So even if the asset is being used for depreciation, for distribution, you should not say this finance cost has to be distribution. No, the interest element from the lease liability is a finance cost and should be under finance costs. So on the next, the other element is the statement of cash flow. This is also very clear on the next slide. If you're really accounting for the leases and they are short term, then they will be in the operating activities, or whatever elements that we have mentioned, the statement of comprehensive income will be here. And the interest and the principal payment on lease liabilities will definitely come as a financing cost. So this is the impact in terms of cash flow. Now that we know how the IFRS affects the numbers, I wanted us to talk a little bit in terms of what happens if the leases change or circumstances that really lead to the measurement of leases change. So on the next slides, I walk you through the subsequent measurement. We have seen the elements that define the lease, a lease term, and the payments that you're making. So what if there are some changes subsequently? So the lease liability and the right of use asset will also change if those changes happen. And in case the changes are on the interest rate, as you can see, you have already recorded your initial lease liability, which is the initial value. You add the interest on the carrying value. Whatever lease payments you make, they are deducted on that. And then if you have remeasured, and that remeasurement we shall see in the subsequent slides, gives you a lease liability. So this is how we expect you to present the lease liability in the financials. One, you need to start with the initial value, add interest, less lease payment, then the closing balance. And these elements should really tie to the elements you have seen. If the interest is in the finance cost, the interest on carrying value in that note should be very clear. And if it is also the lease payments, the cash flow will show that number within the lease payments. So on the next slide, there are other elements that might affect, which we call the revision of measurements. And there are actually 4 situations where you might need to remeasure the lease liability. One, if there's a reassessment of the original lease term or exercise of extension. Like I showed you at the start, the lease term might be a combination of the non-cancelable, then the option to exercise, to extend, or the termination. So any of those factors can change. You can be in a lease term of 8 years, and then you find that the building is no longer sufficient for you, and you want to move. So that is a change in the lease term. And the next year you say, I'm going to move. So that will have an impact on how you measure that. You can also have a reassessment of whether a purchase option will be exercised. We said at the start, we might conclude that the lessee will exercise the option, but market conditions move and things change. That will lead to revision of estimates. And also there might be changes in index affecting the payments. And that is the case where we said some of the lease arrangements might be pegged on indexes that you don't control. Interest rates that are variable. We know banks have variable rates I don't know, they have their prime lending rate. I don't know how they fix it, but you start with 9%, and then they will tell you it is going to increase 12% 2 years after the change. So that also changes the measurement. And then changes in residual guarantee, which I talked about, fair value of the asset at the end of the lease might also change. All those elements actually require, when they change, might lead for you to remeasure the lease liability. So how do you do that? And that's what I wanted to touch on a little bit on the next slide. That once those changes happen, probably actually on that previous slide, Mr. Moderator, they have different impact. On the first two, you need to revise the liability using new assumptions. So that means if the lease term changed from 10 to 8 years, remember you are discounting your cash flow for the next 10 years. Now you have to discount them to 8. So that will give you a new lease liability. For example, if your change is happening in the second or third year. So you need to adjust your lease liability and the right of use asset by that end. So it becomes a balance sheet entry classification. You reduce the liability, you reduce the asset.
Yes, Kenneth. Kenneth, I'm just alerting you that time is not on your side, but you can, don't over rush, but be mindful, we are left with a few minutes.
Okay, thanks, Madam Moderator. And I'm actually also about to wrap up because we are going to be talking about the impact of COVID on this standard.
Okay.
So, like I was saying, that the last two changes will affect the assumptions, and you just have to adjust the right of use asset by the same amount, and that usually impacts the discount rate, but not the cash flows. So on the next slide is what are the changes that affect the right of use asset. I explained that the right of useful asset is sitting actually in your non-current assets. It's either a PPE or an investment property. So the standard IS 16 affects that. You can revalue it. You have to amortize it over the useful life. You can fair value it. And we know how to account for that. Lastly, second, on the next slide, I want us to talk a little bit on lessor modifications. These are very important, that you can be able to modify the lease arrangement, and the modification can come as a result of you having an additional asset or extension of the term. So the best thing you need to do is first ask whether it gives to a separate lease. If it does, you account for it as a separate lease. We have seen how to account for separate lease. If the modification is not, then you have to remeasure the lease liability using whatever impact that it has happened. So whether the modification doesn't give separate rise, it really either extends the scope or it doesn't. When it extends, you have to remeasure the right of use and also measure the liability. And this is where actually we are going to touch a little bit. This is the impact that COVID has had on this element of IFRS. In the last slides, I will mention what kind of impact has come out of here. And as you will see on the next slide, that when it comes to the impact of the modification, I will ask the moderator to move on the next slide. The modification can either give rise to a separate lease or not. If it gives rise to a separate lease, these are the conditions it must fulfill. One, you must either get an additional asset, or it might really, that asset itself have a fair value of equivalent to the assets that you're getting. So just because they have changed the contract terms and the condition doesn't mean there's a separate lease. If you're getting 2 photocopiers and you have another photocopier at relatively the same price, that is a separate lease arrangement. And like I said, each lease arrangement is accounted separately. So I'll walk us through the next slide, and I will ask that Madam Moderator will skip that example, but it will be shared with you, the presentation, so you'll walk through it yourself and go to the next element, which talks about really an element that I want to talk about briefly, which is called the lessor account. So Mr. Moderator, if you move to the next slide, I will skip the example and the answer. Most of the things I've been talking about have been affecting lessees. I hope you understand what I mean by lessee and lessor. A lessee, in most cases, is the one who's buying. The lessor is the one selling. You can say, if I use the connotation of rent, the lessor is the landlord. The lessee is the tenant. So what I've been explaining is actually affects the tenant, how to account for leases as a tenant. What about if you are the landlord? I want to tell you that when you are the landlord, things are actually a little bit different. When you are the landlord, you have the same arrangements that were there in IS 17. You have to ask yourself whether the lease arrangement you have gives rise to operating or finance. I need to clarify, this option is only available to landlords or lessors. If you are a tenant, please don't do this. There are no operating leases anymore. If you are a lessee, this question or classification is only available when you are a lessor or tenant. So if you are a tenant, this slide should not be looked at. But if you're a landlord or lessor, you ask yourself, is the lease arrangement operating or finance lease? If it's finance lease, I'm going to show you how to account for that. If it's operating, it's the same principle. You recognize rental income on a straight line basis. For the next slide, I will share with you on the requirements for you to call the arrangement a finance lease. Any of these five, just any, 1 out of 5, does the lease transfer ownership of underlying lease to by end of the lease term? If the answer is yes, that's a finance lease. You don't have to look at the others. Expectation that the lessee will exercise an option to purchase the price. If the answer is yes, that is a finance lease arrangement. If the lease term is for the major part of the economic life of the asset, this is a finance lease. If the present value of the lease payment approximates the fair value of the leased assets, you can see the word minimum is crossed out because that was IS 17 language, but this case doesn't require minimum. If the answer is yes, that's a finance lease. And if it's specialized nature of lease assets, the answer is yes. So how do you account for finance lease? It's on the next slide, which I will also touch a little bit briefly. But before I do, I just wanted to explain that as a lessor or the landlord, and I have seen these arrangements actually in arcades. The landlord leases the shop to a tenant, then a tenant also becomes the landlord. He gets also somebody to live. This IFRS accounts for that arrangement. If the first landlord, the owner of the building, is called the head lessor, and then leases the building to the shop to a tenant, and then the tenant gets another tenant, that it becomes the intermediate lessor. Then the person that they have brought on to just get a shelf becomes the sublease. As you can see in this arrangement, it is very funny that you move from being a tenant to a landlord. And in that case, you have the responsibility to account as a lessee and account as a lessor. So something to watch out for. For the next slide, I will show you what it takes to be able to account for that. So I will ask that we'll move on the next slide. I have already explained this, that if you are subleasing, you have both arrangements. So in subleasing, you will have to account if you conclude that the subleasing arrangement is the operating lease, then you just get the rental income and account for them as your rental income. But if it's a finance lease, the accounting is on the next slide. I will ask the moderator to move us to the next slide. If you have a finance lease arrangement, then what you have to do is account for the lease arrangement first as a lease arrangement. So you'll have the right of use, which the landlord will have given you, and then you will have a lease liability. But then you'll have to sell this right of use partially to another person. So meaning that you will have to recognize these receivables, okay, and recognize the right of use element that you have sold. And I think that actually will become a little bit complex, especially if you have a finance lease arrangement and you are in a sublease arrangement. So I will ask the moderator to move us to the next slide, which is basically recognition of the fact that as a lessee, you can have a modification which affects the lessor as well. In this case, if you are the lessor and there is a modification, you just ask yourself, does it give rise to a lease, an operating lease or a finance lease? If it's a finance lease, this is what you do. After the modification, you just recognize the prepaid lease payments and treat them as receivables. And then you just ignore the accounting for rental income on a straight line basis. So you don't even have to restate the prior numbers. So meaning it recognizes that you can have a modification that moves you from one classification to another. The second last, before we move on to the COVID impact, I will ask the moderator to just talk a little bit briefly on the leaseback. And this I have experienced firsthand. We need to be very clear that there are some leases that can give arrangements of a sale and a leaseback. And in that case, the impact is very clear. I actually have a client who has an arrangement with the bank, but he was confusing that arrangement to mean a leaseback. On the next slides, I will show you that what is important for the lease to be called a leaseback. First, if you lease an asset and you have to forego control, that means that if you have sold it, first you have to forego control and then get it back. The asset has to move the control to the buyer, and then the buyer has to move it back. So on the next slide, I will show you how we used to be able to conclude that arrangement that I had with my bankers. And we use the first column here. You have to first subject that transaction. Does the sale meet the criteria of performance obligation under IFRS 15? If the answer is yes, then that sale has happened. But if it is a no, that arrangement is not a sale leaseback. So in that case, we took on our client and told them that what you have is a loan from the bank, because all they give you is money, and then you pass the asset to another person. So they are not interested. They are financing your arrangement with another client, only that even if the cards are in the logbooks are in their names. So you can see that it is important for you to evaluate when does a sale and leaseback transaction happen before you account for them wrongly. So if they happen and the answer is yes, this is what happens. You have to recognize the asset, you as the seller, and then you have to put it back as a right of use. So I can have a vehicle that I sell and then lease back. So it comes out of my assets as inventory and then comes back as a right of use. If it was an asset that I'm using in a PPE, I will recognize it, and then it will come back in the form of right of use. So that is also very important. So lastly, I will move through. I'm not going to talk through the next slides because we have already touched on a little bit. Mr. Moderator, I ask us to move on the part of the impact of COVID on this standard. The transition, I've talked through it. This standard was effective and the retroactive application. So I will talk about the impact of COVID. These are some of the questions that we have actually internalized with my colleagues within BDO. And we are wondering what were the answers. If you are, you know that very well government directed that we, as landlords, if you're a landlord, Museveni said that, oh, our judge said that we have to be patient, okay? But people are actually not also working. So if you are the landlord, you have closed the tenant has closed the shop, but he has the right of use asset. So the question that we ask, does he still depreciate the right of use asset, or he suspends depreciation? And the IFRS 16 says actually no, because depreciation is for starts and the commencement when the asset is available for use. So unfortunately, even if they have suspended they're not working, you have to amortize the right of use asset. And you know very well as well that IS 16 says you have to depreciate assets over the systematic. So even if the asset is not being used, I know IFRS 16 says, so long as the asset is available for use, you continue depreciating. So nobody should talk about suspending depreciation or amortization of right of use just because of COVID-19. I've given you that answer. Then there are some people who are asking that if the lessor is required to stop recognizing operating lease, in this case, you are the landlord, the tenant is not paying, he's not using the building, judge has said, or our grandfather has said, you be patient. Do you still recognize income or do you stop? IFRS 16 actually, in this case, I'm assuming it's an operating lease. And I need to clarify for you guys that when you have tenants on the building, the tenants will account for the right of use of that building as their balance sheet, but doesn't mean that they will go away with the house at the end of the tenancy agreement. So they will have an element capitalized of right of use, but you as the landlord, you actually have your building as your asset and you will treat it as operating lease. So I want to make it very clear, if you're having a house or a property, to the lessor, it is actually already an operating lease. You don't have to worry about the classification. So the rent, in this case, will be recognized systematically. So the question we are asking, if you are the landlord and the people are no longer paying, do you stop recognizing operating lease income? I want to tell you that IFRS 16 just basically recommends that if it's operating income, recognize over a straight line basis. So you should continue recognizing the income, but maybe the question is it recoverable? And that is something that I cover on the next slide. That the next question is that even if you're not going to collect, do you still recognize? There's no clear-cut answer in IFRS 16, but this is my view, and this is, it says that since IFRS 16 doesn't talk about failure to recognize because of uncertainty, you still recognize the income, but you subject that receivable to an impairment test, which is purely also another IFRS if you're doing impairment testing. So you'll have your income up there, but if you're sure you're not going to recover it, maybe take it out through a provision. So that the other school of thought is probably if you're getting cash, maybe you recognize it on cash collection. So those are some of the thoughts that I had about the impact of this COVID on the standard. But on the next slide, there is the next two slides I want to share with you that this COVID actually affected many businesses. And as accountants, we didn't go to sleep. The Accounting Standards Board has made some recommendation to amendments. And these are the developments. On 10th April, the board received a lot of questions and they gave some responses, which was called an education document to guide, because many people were killing them with questions. But on the same day, our colleagues in the US, which is called the Financial Accounting Standards Board, also gave responses to some queries. However, their responses were in more detail. They were better than the ISB board document. So the ISB recognized that for them to give a detailed response, it required for them to amend IFRS 16. So on 17th April, they sat and they considered some amendments. And those amendments were published in an exposure draft, which actually the board got a special approval from the IFRS Foundation to make sure that the exposure draft is only available for 14 days instead of the period that we know usually is permitted. So those amendments, that date was closed on 8th May. I'm hopeful that by the end of May, in the next couple of weeks, those amendments are going to be effective, and they are going to be effective 1st June 2020. So what are the amendments? On the next slide, I want to share with you the amendments that the board has recommended. Therefore, first, most of the amendments rotated about the concessions, the changes that the landlords or the lessors were giving the lessees. And I have explained to you under modification that if there's a change in the contract, it's considered a modification. So if there's a modification, you need to first ask yourself, does it change? Is it a new contract or does it change the scope? And like I've said, you have to do that on each lease arrangement case-by-case basis. So imagine you are a bank, you have 500 branches, or not only a bank, you are a shopping mall all over Uganda, on all cities, and the landlords are giving concessions. So if you have 200 lease arrangements, you have to do that on each lease arrangement. And then if it requires you to measure the liability and right of use afresh, you have to do that for all the 200. So it was a lot of pressure. As CFOs, you're worried about who to pay. And then this IFRS 16 is making a pain out of it. So the board recognized the pain that was coming as a result of concession. So they proposed this for, they said that provide lease with exemption from requirement to determine whether. So basically they provided the relief that if you've got concession from your landlord, it will not result into a lease modification. Right away, you don't have to worry about whether it's a lease modification or not. So you just don't have to have that pressure. The second is that to require that leases that apply the exemptions to account for COVID-19 related concession as if they were not lease modifications. So basically, the first step, they took it out of the equation. The next step, they didn't require you to remeasure the lease liability and right of use. The third step is to allow those entities that elect to use this exemption to disclose that fact. And then lastly, to require the leases to apply the exemptions retrospectively, meaning they can just account for the impact of those exemptions through their retained earnings without necessarily stating the prior numbers, just the opening retained earnings. So these are the 4 amendments that were in the exposure draft. Like I said, it's coming out in 2 weeks. I have seen that they received over 110 comments from the 14-day window. So it is possible that the amendments might be different from what I'm sharing with you. So if that is the case, please don't come and say I gave you a wrong view. Like I said, the final product might not necessarily be exactly what I'm sharing, but this is what was in the exposure draft. And the conditions on the next slide for you to benefit from these amendments, which I will ask the moderator to show and we'll end the presentation, is 1, that the change of the payment should have resulted from the consideration for the lease is substantially the same, meaning the changes that or the concessions that have been provided by the landlord should be a little bit less or substantially the same. So we shouldn't expect to have a revision, a concession that leads to more lease payments. It should be a less, substantially the same or less than the consideration in case there was no concession. 2, the reduction in lease payments affects only payments originally due in 2020. So if you have concessions that go all the way to 2021, they are saying these proposed amendments, you're not going to enjoy them. And then lastly, there's no substantive change in other terms and conditions. So if you get concessions on the leases from the lessors as a result of COVID-19, it should not affect other terms and conditions. If it does, then you're not supposed to enjoy the benefits of these amendments. With that, I want to end my presentation and open it up to any questions that you might have. Over to you, Madam Moderator.
Thank you very much, CPA Kenneth. I think the members have greatly benefited. When I tried to warn you about time, they wanted me to keep quiet because they were really enjoying. And we thank you very much for sparing your time to come and share with us. You are not yet late free. You have quite a number of questions. If from your screen, you could also check with me, there are questions and answers. I mean, the question and answer, and I would like to quickly take you through some of them, and you can give some of the answers. Because of time, I don't have to repeat your presentation by trying to summarize it, because you have really said it all from the presentation. You have also told us that we should not be so creative by refusing to depreciate or refusing to do certain things, and we thank you. There are a few questions. I don't know whether you can see them. There is a question from Josephine. It says that in case I realized that I did not apply the lease into my 2019
Yes, I can see them.
You can see them. Okay, so we can move from the top. I wanted I'm looking at them by popularity, and I can see the first one is, in case I realize that I did not apply the lease into my 2019 accounts, yet the standard was effective 1st January 2019, and from the explanation, it affects all financial statements. Is it okay to effect it in the accounts of 2020? Thank you. That was a question from Josephine. I will point you to 3 of them, then you can first deal with them. And the next is, thank you for the webinars. I've received one, sorry. What are the tax benefits available to a lessor as opposed to a landlord in rental tax computation? So you could deal with these 2. The first, I think they did not apply the lease on its effective date, and they're wondering what to do now in 2020. Over to you, Kenneth. Kenneth, are we there? Members, we seem to have lost Kenneth. Kenneth, are you there? Okay, let me try to check on Kenneth. Okay, as CPA Kenneth is trying to come back online, there was a question that kept coming up, whether these slides will be shared. Yes, they will be shared with us. Kenneth, you're back?
Madam Gloria, I'm back. I don't know what's happening here, but I'm back.
Yeah, that was the devil, but we are glad you're back. So we are I had pointed you to this question from Josephine Nantongo. If you can see it, that in case I realized I did not apply the lease into my 2019 accounts, yet the standard was effective 1st January 2019, can they do it in 2020? And also the other question was, is there a revision to terms? Is it if there is a revision in terms, is it proper to recognize the balance in the running lease and recognize a new one? So I had requested that you could attend to those as I sieve through the others.
Okay. It is very unfortunate that your accounts probably were released without really applying this standard, and you've just realized it is. To be honest, I don't know whether those accounts still qualify to be called IFRS compliant accounts. My view might be a little bit conservative. Is first, you probably need to quantify the impact of you not doing the right thing and see what would be the impact on the results that you already shared with your stakeholders. I think from that, because we know very well as accountants, we deal with only material things. If the impact is material, my suggestion would be that you recall the accounts and do the right thing, because it is not showing a true picture. It's not showing a true picture, which I think all accountants aim for when we prepare financial statements. So it might not be too late for you to reissue accounts that show the true picture. But if it is not material, because even if you to restate and reissue the accounts, fundamentally, the results will not far that maybe you can pick up and correct that subsequently. But my quick thought is that you need to quantify the impact of you not doing the right thing. Then you can be able to take the next step after you have quantified. It's very difficult for us to sit here and give you the right advice if you have not done the first step of quantifying the departure. So my view is after this presentation, you with your colleagues and your auditor should really sit and evaluate the impact of if you had adopted and done the right thing, how would the results look like? Then you can be able to take it up from there. Madam Guru might have to remind me on the second one. I actually didn't get it very well.
Okay, the second question is that if there is a revision in terms, I guess the terms of the lease, is it proper to derecognize the balance on the running lease and recognize a new one?
It depends on how you want to do it. The standard requires you to, if there is a change in terms, to evaluate whether the modification in terms give rise to a new asset or not. Not a new asset, give rise to a new lease arrangement or not. And I said the new lease arrangement will happen if you've got a new right of use asset. For example, you are having 40 vehicles, they have added you another 3, and the fair value of the 3 are equally almost the same independently. So that becomes a new lease arrangement. So you account for it separately, meaning you will have an addition to your right of use and an addition to your lease liability, which is coming from a new lease arrangement. But if the modification leads to a change in scope, it is not a new lease arrangement, but a change in scope of the existing arrangement, then you have to quantify the impact on the lease liability and right of use asset you have recognized. That might mean writing down the lease liability and the right of use asset. So the ideal, to answer your question, is to write down, to change the existing entries as a result of the impact, instead of you recognizing, reversing the original as if it didn't exist. That will not be good or appropriate accounting entry in terms of recording the GL. So you just effect the changes on the existing. And even in your workings, it becomes very, very clear. But if you reverse the transaction, it's like you're undoing the original lease arrangement, which is factual is not correct. So you just apply the changes in the existing lease arrangement. And as the slides will show, the change in scope might require you actually also, it has a dual effect. So the change in scope might just need you to revise the lease liability and right of use asset, or it might require you as well to remeasure the lease liability as a result of using a new discount rate. So those have different implications.
Okay, thank you very much, Kenneth. There is this question from Amos. He says that what other tax benefits are available to a lessor as opposed to a landlord in rental tax computation? Perhaps he meant a lessor of other property other than land, landlords. So what are some of the tax benefits available? I know it doesn't necessarily fit in IFRS 16, it's more of a tax practice matter.
I will take a stab at that. Yes, Madam Gloria, you're right. It is not an IFRS matter. But what I know that this new standard has made the changes in how we account for leases, and it has brought an asset on the books of many entities that was never recognized before. So it has brought an asset and a liability. But the tax laws have not caught up with the changes. The tax laws are still as they are. Yes. And you know, in the past, the tax laws, you would treat most of the transactions, you would have to If it's an operating lease, the rentals would be acceptable as a tax deductible for the leasee and income for the lessor. So what I have seen is that the taxman has actually stuck to the original treatment. What it has done is the impact of IFRS 16 is now among the disallowable items. So you will see the amortization for right of use asset is added back. The finance cost that goes in the statement of comprehensive income is added back. And that means as an accountant, you have to keep track of the lease payments. So the lease payments that there would be expense for the 12 months is what is deducted as an expense to the taxman, because that's what the tax laws still recognize. So to the landlord, in this case, the lessor, like I said, for the lessor, the first step is to classify whether operating or finance lease. And if it's operating lease, you just recognize income evenly on a straight line basis. And you know, if it is a property, the rental taxes in Uganda, you account for that rental tax separately from the normal business income. And if you're an individual, there are limitations in the deduction. 20% is the maximum you can allow to deduct. And you slap your 30%, or whatever bracket you fall in. If you're an individual, you have to only allow, the deductions that are allowable are only those expenses related to that asset. Thank God the parliamentarians for, I think in a rare case of being sensible, they disallowed one of the provisions that the government was proposing to also cap those expenses. So that means that those deductions, once you deduct them from the income that you've deducted, that you have your net income that you subject to tax. So in sum, I want to say that as a result of change of this standard, it has not had any impact on how you account for taxes from the rentals, either property or leased assets. It hasn't. It has actually created more work for an accountant to be able to monitor. There would be expense that needs to be accepted by the taxman as a deduction. So it has created extra obligation to make sure that you reverse the accounting transactions in the tax computation and then claim the right deduction that URA will trace as income that your landlord has declared in their returns, because they do that now very well.
Thank you very much, Kenneth. I will for now first skip the tax questions so that we deal with IFRS 16 direct questions, because we have about 18 minutes. Please elaborate on whether or not retrospective application is a must. I guess this person means when they are adopting IFRS 16 for the first time.
No, you have actually two methods that are allowable. First, you have the retrospective application. You choose which one, or the modified retrospective application. The modified is that you don't restate the comparatives. You just quantify the impact in the current year. So I have seen that for most of, and I've advised for most of my clients, we choose the easier option, because retrospective, you have to do 3 elements of the balance sheet, three years, then all these fancy things. It's just creating more work for yourself. So you just do the modified retrospect, and usually what happens is that you just recognize the asset and liability, and the comparative for last year will be nil. So it is an option, and I've seen many. I have not seen an accountant who has taken the retrospective one. I have not seen a mad one, because in this era of COVID, we are worried about cash flows more than this fancy restatement of prior years.
Okay, and related to that, should an entity, related to that, Kenneth, should an entity provide disclosures about lease concessions related to the effects of COVID-19 pandemic?
Absolutely. That is one of the amendments that's provided for, that once you do that, you have to disclose.
Okay, thank you. And did you say that Application of this IFRS began in January 19. So if I had to make adjustments, that one you have already answered it. It's similar to the first one. And it says, does the qualification criteria of a lease applicable to both operating and finance lease?
If you are a lessee, in this case, I will take the saying a tenant, or you are the buyer, you don't have to take that option of asking whether it is operating or finance. You just have to identify whether it is a lease arrangement. That is all. The other classification is only for landlords or the sellers. So if you are lessee, that question should not arise in your head at all.
Okay, there is the next question. Okay, that one was answered. In reference to the rental arrangements, if the company relocates its premises and incurred the cost of renovation of current premises and the old building, IFRS 16 was applied. What is the correct accounting treatment? The lease term contract was terminated, yet it had outstanding balances on the right of use of the asset and the lease liability.
Yes, in that case, like we said, the lease, for you to have the right of use assets, like the formula I've shared with you, start with the value you've got with the lease liability, you add on those direct payments and early payments related to the contract and the other two elements that are put in the formula. So if the lease is terminated, usually probably the lease liability has been extinguished. So you're going to make your adjustment from the lease liability and the right of use asset. If there is any element that is left, it will be those added components that you talk about restoring the asset or direct costs incurred. So in that case, there is no asset for you to use anymore, to enjoy. So you have to write them off. It's like actually an impairment of your asset. You write them through the P&L. Then for the new lease arrangement with your new landlord, you start the game all afresh. You account for that lease arrangement separately, because it's a new lease arrangement, and you just read the terms and conditions and apply this standard.
Okay, there are these two. Does this standard encompass hire purchase transactions and events? And two, in case one party cancels the contract along the way, the lease contract, how will the underlying asset be valued? So they are two in one.
Yeah, I think I'll first take on the last one. It is similar to what I explained. If the transaction is cancelled, how will the underlying asset be valued? I mean, if the lease arrangement is cancelled, let's agree in principle that the right for you to use the asset has been cancelled. Meaning, if you had a property, if you're a tenant, the landlord has said, get out of my house. You're no longer going to use the space. If it is a vehicle that you've been leased to you, the guy is saying, bring my vehicle back. So you no longer have the right to use the asset. So that right has been extinguished. So that means you need to take it off your balance sheet. And also, depending on the termination arrangement, the liability as well probably might have been extinguished or it has remained, depending on how smart your lawyer was. But if it has been extinguished, so you have to reduce the liability with the lease, because the liability is a component of the right of use asset. And if there is a component of right of use asset that has remained, then you have to write it off, because you're no longer going to, it is extinguishable, you're no longer going to enjoy it. So you have to write off that asset through the P&L because it's probably impaired because of the conditions of termination. So yeah, it's as simple as that. Then in terms of hire purchase, like I said, the first, you have to just take through the step that in terms of identifying whether it's a lease arrangement. And let me actually make it clear that not all lease arrangements will have the word lease agreement in their contracts. So that means if you're an accountant or auditor, you have to read a contract thoroughly. Whatever contract they give you, you have to first read it. First, is there an underlying asset in that contract? It might be called a memorandum of understanding. It might be called another fancy term. I don't know where these lawyers get these fancy terms, but whatever they call it, so long as it is a contract, you have to read if there's an underlying asset that has been identified. That is the first step. The next step is that asset, you, the buyer or the lessee, or the person who's getting the asset, are you enjoying the full, almost the full right, useful life of the asset? If the answer is yes, then in the third step, do you have control? Do you direct? If you have a photocopier in your office and you're going to decide how many papers it prints, you have control on how you're going to use it. So then that becomes a lease arrangement. So whether it's called a hire purchase or not, it doesn't matter. It becomes a lease arrangement. But if it is a no, then the next standard applies. So it might be hire purchase to account for under IFRS 15. So the answer is for you to do the 3 steps. And if the answer is that it is a lease arrangement, you apply this standard. So you don't look at the titles or the heading or the chronotology of whatever contract that has been given to you.
Okay, thank you very much. And the next one is, in the event of remeasuring the estimates, does the standard supersede IS 8?
In the measurement of what?
The person wasn't clear, but I guess it's maybe in the event of remeasuring the estimates. I can assume that maybe you're measuring the estimated cash inflows, maybe, or an outflows. So yeah, does this standard IFRS 16 supersede IS 8, that is accounting policies and changes in estimates?
Okay, the two standards are actually standalone. One doesn't conflict with the other. What it basically, to just recognize is exactly the principles of IS 8, that the changes that might come into the lease arrangement are arising out of estimates. So, for example, the variables, you had estimated that the lease period will be exercised. That's an estimate, it's a judgment. So if things change, you don't go back and restate, you just pick them at the point of change and change prospectively. So it actually complements what IS 8 says. If it's an estimate, you don't restate, you don't go to make the changes retrospectively, you pick them and prospectively move with them. So it is not contradicts, it just complements.
Okay, thank you. This one is asking, if your leases are fully prepaid for their useful life, is there any impact due to COVID-19?
That's a nice one.
Yeah.
That's a nice one. And actually somebody was saying that if this COVID-19 was an accounting problem, we wouldn't be locked down because accountants are creative. We would be having a standard for it. But I think in this case, you're trying to superimpose COVID-19 on an arrangement. This, if you have already prepaid money to the landlord, I don't know whether you can call him and say, please give me something because this COVID-19, President said that you will be patient, give me back the money. I don't see that happening because if I was the landlord, I would call you mad. So the impact that I've explained to you of COVID-19 only arises if you, the lessee and the lessor, have sat down and the lessor has granted you concessions. The concessions might be in rent holiday, the concessions might be in reduced rent, the concessions might be in agreeing when to collect. So those concessions are the ones that the amendment try to address. But if you have not had any concession, you are happy that you are actually an essential worker like Gloria, for you, you're still earning. So you don't have to go to the landlord to ask for concessions. You don't have to worry about the amendments that they have been that are being proposed because COVID has not impacted you. If you're prepaid, you will be in that category of no impact on COVID on you.
Okay, thank you very much, Kenneth. I'm an essential worker here at the bank, but in terms of other places, they said the students go home. So even me, my sources of income were put aside. But the next question says, what is the treatment on transition? For long terms, say 9 years, leased land on adoption of IFRS 16. The land was recognized as prepaid lease land under IS 17 as at 31st December 2018 and amortized over the lease term historically. Kindly give relevant standard reference. This one is a potential client of BDO.
Yeah, and I'm glad to support them. But I think the references have been in my presentation. If it's been a lease for 99 years and you accumulated the prepaid lease rentals or you prepaid them and you've been showing them as an asset on the statement of financial position and calling them prepaid lease rentals, with this new standard, they will change the name from prepaid lease rentals to right of use asset, okay? And if those prepaid lease rentals require you to make subsequent payments for the next 99 years, then you have to also discount those payments. If, for example, you paid upfront 500 million to Uganda Land Board, giving an example, but each year you have to pay busuru of another 1 million for the 99 years, you've not been, in the old standard, you were not recognizing the busuru of 1 million every year. You just recognize the prepaid upfront payments. What this standard will require that even those no prepayment, now you have to discount them and add them to the already recognized prepaid lease rentals. So your right of use will grow, and then you'll have a lease liability that you will have to bring on board for the next 99 years. But if the prepaid lease rentals doesn't require for you to make any annual payments, then basically, in principle, your asset that you have changes from just being called a prepaid lease rental to a right of use asset. So it's just a change in terminology.
Okay, and CPA Kavuyo has a request in I seek for clarity on an indefinite scenario. When we are faced with an economic conundrum, like the case in which COVID-19, where business is put at a halt and where there is a state of emergency is declared in an economy, is there any specification regarding the lease contract since the asset leased out is out of production due to suspension of production?
I think, to be honest, I will refer this, you just need to walk to your lawyer. What I'm explaining to you is the impact, the accounting impact of the legal all these arrangement you enter with your lessor or landlord. But the legal impact might be totally different. And that might also have different financial consequences. So I would really suggest that you pull out that contract you have, sit with your lawyer. If there are any rooms for you, I've read that this is force majeure clauses that you can claim and say this was an act of God because it's a pandemic. I cannot parent. Those are all aspects that I'm sure a legal professional can be able to help you. And I want to actually tell you that even me, in my capacity as a leader in BDO, I've benefited from legal counsel around this period on some of the decisions that I thought we could take. So I don't want to actually really misrepresent by attempting to answer that question. Just talk to your lawyer and look through the provisions of your agreement that you have. There might be some aspects you might benefit from.
Okay, thank you very much, CPA Kenneth. Yeah, maybe something clear about COVID-19 from the contracting point of view. The guidance is that COVID-19 is not really force majeure for most of the contracts because it just makes it difficult to perform, but it doesn't make it impossible. So therefore, as you have said, yes, they would need to consult their lawyers, and also it depends on how it was put, how that was force majeure contract clause was put in the contracts. But otherwise, this COVID-19 is not really a force majeure contract as far as the guidance, at least to the procurement fraternity where I belong, has been given by FIDIC, because we use FIDIC contracting regulations. However, in accounting, we still have to look at all the provisions of various standards And you'll find that even when it doesn't become a force majeure, it definitely results in some provisions, some impairments, so each one needs to look at it case by case basis. There are many tax questions. I think members, I'm looking at the time and it's almost 4. And those ones, I think they will be answered later, especially how do you apply VAT. I think they will be answered by the ISPAO technical team, and then they will be posted. Through these webinars, ICPAU is collecting all the questions, and there will be those questions, and they will be posted to the website and to the mails, I guess. Maybe one last one. What of a scenario where a lessor offers a discount to the lessee? How do you cater for that in the books? I guess this person didn't get the original, but you can answer that as the last question from these ones, and the rest will be answered by the technical teams and posted.
Thanks, Madam Gloria. I think that one we said you might just has an impact on your measurement of lease liability. Whatever discount or concessions that you get from the lessor, you just need to deduct it from your, if you look at the formula for lease liability, and I'm sure the presentation will be shared, you just take away whatever concession or discounts that you get from the lessor. So if the lessor gave you some free month off, then you just deduct that in determining your lease liability. So the impact is that it reduces on the liability that would have been recognized if you get some discount or concession from your lessor or landlord.
Okay, thank you very much, CPA Kenneth. Makanga, you have really done a very great job. Everybody is very happy. I know you have not been able to look through the charts, but I can assure you that the attendees have not had enough of you. And I'm sure from them, you will have quite a number of clients for BDO. And I would like to thank all members for having attended. We have a webinar tomorrow, internal audit and risk management. And we will be having the moderator as our very own Vice President, CPA Ruth Doreen Mutebe. She will be moderating the internal audit and risk management webinar. And the facilitator will be Doreen Wakatungu Musime, Head of Internal Audit, Stanbic Bank, and Mr. Adam Sengova, Associate Director, Pricewaterhouse. So please let us use this chance to accumulate the hours so that we don't also want to use force majeure for CPD. I recognize the council members who are present with us today. Our president, CPA Frederick Kibedi, I can see he signed in, quietly sat, and all the other CPA Constant Otieno Mayende, I can see he's seated quiet. Of course, I recognize our CEO, Derek, and all other members of CPA who are here, who have attended, staff from the ISPAO. We appreciate all of you. And see you again tomorrow for another yet enriching webinar. And thank you for the enthusiasm that you have shown towards the profession. May you have a blessed evening.
Clarification, the webinar is on Friday.
Sorry, it's on Friday. Yeah, Friday, May 22nd, the internal risk and the internal audit and risk management webinar. It is on Friday, 22nd, not tomorrow. So sorry, John, I was handling emergency procurement, so my head thinks tomorrow is Friday.
That's acceptable.
Okay, then. Thank you very much, members, and may God bless you all.
Thank you, Gloria. Thank you, CPA Makanga.
You may live at leisure and take tea in your homes on behalf of ISPAO.
Thank you.
The CPA is providing online tea evening. So you can pour a cup of tea.
Very nice, very nice, very nice.
Yeah, this has really taught us a big lesson that we don't have to have spent all that fuel to go to Grand Imperial and to go to Africana. I mean, we are using internet and we are quite okay. The attendance is really high.
It peaked at 529.
Yes, 529 plus those who joined as hosts. So, yeah, that's very good. It means people are embracing technology.
Yes.